Good evening, everyone.
Good evening, sir.
Good evening, sir.
Good evening, sir.
Okay, how are you?
Good evening, sir.
How are you always, okay?
We thank you, sir.
Okay, so
Sir, and yours?
thank God though. Apology again for inability to hold the class on Thursday. The network was anything like we just decided to just block the way. We try so many ways. In fact, we try using like 2 other accounts to make sure we class. And despite even trying till around past 10 to really still work. So without wasting time, today we'll be taking up on IFRS 13, fair value measurements, and I hope we are ready. So let me bring the YouTube link for those that will be. For those that will want to join. I just want to share YouTube link for others so that you can continue. Someone started again.
Please, Amata, your mic. Please.
So I guess we can start now. I've shared the YouTube link so others could join through that. So good evening once again.
Good evening, sir.
Good evening,
Topic we are
sir.
treating tonight is IFRS 13, fair value measurements. I must say at the beginning of this lecture that for this diet, we've gone through the new syllabus as regards the SBR, and what we discovered is the fact that there has not been any significant change to what CL represent before. Only 2 areas are emphasized more now. So, and those areas were already present in the previous syllabus too, but I guess when they bring out the pack, they will pay more attention to it than before. And because it was part of the reasons they decide to change, because they want to align with ACCA. So those areas has to do with sustainability reporting and emerging issues, like what are the current issues as regards financial reporting is concerned. So those are the two areas, and those ones are majorly theoretical, and it's connected with how well you. That sustainability reporting is a global issue, yes. That globally, accounting profession is moving away from just numbers, but what are the significance of those numbers? So just take note of that. In the light of that, in this syllabus, the way I see it is that they have now packed all the standards together. I did an introduction of the syllabus, I think 2 or 3 weeks ago. I can't remember exactly. So that implies that it makes it easier. Yes, those standards they want to test as far as the SBR is concerned have now been brought together. So that makes it easier. And although we have a total of around 43 standards, that's cumbersome, but notwithstanding the approaches to it, and I hope I'll be able to guide you through when the exam is at least a month to, so that you know how to really streamline what you will focus on and what areas you should pay more attention to. So this standard is one of the standards they usually love to test actually. If you go through the past question, you will see it coming out more often than not. So it's one of the standards you should pay attention to. Yeah. So we'll be starting off. And then to start off again, I must say that when it comes to standard, please, I emphasized it while I was doing the introduction to the syllabus, that for standards, there are three key things that are very, very important. You must tell them what the content of that standard is, that's the scope. And you must also tell them the measurement and presentation. So every other thing is now application, how that standard is to be applied to the scenario they will give you. So you must be able to analyze that scenario through the three things I mentioned earlier, the scope of that standard. Then tell them the measurements, tell them the presentation as well. So when you are able to do this, and then you now apply, because what you are doing at this level is analysis. So you analyze that scenario, then you apply the standard to it, whether it's applicable or not. So if you do that, even if the question may not directly ask you all these things I'm telling you, but that's the way to answer standard related question. So, and if you do that, you won't regret it. So if you're able to do it for all the standard sets for that diet, be it may, if you do like average in every other questions, you get your pass mark around 60 or thereabout. I can bet it with you. So that's why we need to understand what's the approach. So let's start off. We'll be looking at the objective. We'll be looking at the scope, measurement, and then how some other content of what this standard is all about. So the objective of this standards is we want to of this write-up rather is to define fair value, also set out in a single IFRS a framework for measuring fair value, and requires disclosures about fair value measurement. So let me tell you this, because it's not going to be the best for us to just be talking theoretically. When it comes to fair value, what fair value is what is the applicable price for an asset or a liability. That's it. As of now, as at the time you want to measure it, what is the applicable price for it? So just get it as basic, as simple as that. And it's very, very common in companies that are multinationals, companies that are PLC, and they are actually in the stock exchange market. Those that are highly regulated, let me put it that way. So it's very common. but some of our companies we interact with may not see the practicality of this. So that's why I need to mention this to you guys. So, but the basic thing is that just take for instance now you have a car, a motor car. In those terrain, for every year financial reports you are preparing, you will not just go ahead and say, oh, what's the carrying amount you have deducted the accumulated depreciation, then the balance. No, you also try and see that what is the worth of this car in the market as at that time. So that's worth is what where value measurement comes in, and the process to it we actually look at all that here tonight. So the definition of fair value focuses on assets and liabilities because they are a primary subject of accounting measurement. In addition, this IFRS shall be applied to an entity's own equity instruments measured at fair value. So I just told you what fair value is. I hope one or two people, I hope everyone get a glimpse of that, and that simplifies it, right? Are we together?
Yes, sir.
Yes, sir.
I need to. Okay. Does that simplify it the way I just break it down? Like you don't need to start looking at unnecessary bogus definition. What
Please
it's
come
all
again.
about is what it's all about when it comes to fair value is what is the price, what is the worth of that particular asset or a liability as at the point you want to measure it. So in doing that, you need to get to the market. And I gave an example of and I told you that it's usually applicable in a highly regulated companies. Yes, multinationals and PLCs like that. So then I gave an example of a car, even a computer, a laptop, and things like that. You don't just decide on the basis of your financial statements. We have um IS 16, which has to do with your PPE. So it gives two options for you to come about your um yearly valuation of that assets. The approach for you to measure it rather. So you have the option of you doing the depreciation part. That's the cost approach. The other approach is evaluation. That evaluation you use, they are going to definitely use fair value. So that's why this is very, very important. So this standard applies when another standard requires or permits fair value measurements or disclosures about fair value measurements. So if you want to tell them about what this standard is all about, please just understand all this I'm mentioning now. Mentioning now. Start from the fact that it doesn't just come on its own. You can't say, oh, IFRS starting is fair value. Yes, it's applicable to all assets and all liability. No, it's applicable to those standards that requires fair value measurement. I just mentioned one, which is IS 16. Okay, so there are other asset related standard that does not require you using IFRS 13. So that has to be clear. This is part of the scope, and these are the ways they really love you to analyze it, to explain when it comes to answering questions related to it. So it requires when a fair value measurement is requested by a particular standard or disclosures about it. So the measurement and disclosure requirements of that do not apply to the following. That is all these listed standard do not require you using fair value measurement. First, IFRS 2 share-based payments. So that has to do with when you have to use your equity to measure the settlement between in a transaction. So let me put it that way. Don't let me complicate it. So when you have a transaction and the way you want to measure how you want to pay back is you want to use your equity. So the value of your equity will determine the worth of how much you want to pay back to the person you are owing or the person that owes you, as the case may be. So we also have lease transactions accounted for in accordance with IFRS 16 leases. So IFRS 2 share-based payment is not required for you to use fair value. IFRS 16 leases, before now, it's usually called IAS 17. So, but now it is IFRS 16. So, measurements that have some similarities to fair value, but are not fair value, such as a net realizable value in IAS 2 inventories or value in use in IAS 36 impairment of assets. So, all of this do not require you using IFRS 13. Please take notes. They are not much. They are just three. As I do some other ones that will be mentioned are disclosures. We should get it rightly. So those ones that require measurements that you cannot use IFRS 13 for: IFRS 2, share-based payments; IFRS 16, leases; and IAS 2 and IAS 36. So you should note that candidly. So disclosure required by this standard are not required for the following: A, planned assets measured at fair value in accordance with IAS 19 employee benefits. Let me clarify something there. When they mention that planned assets measured at fair value, you will be confused in a way that, and they said it's not requiring IFRS 13 fair value. Yes, that was why I started with explaining what fair value actually implies. Yes, the worth of that particular thing as at the point of measurement, the time of measurement. So that employee benefits, as it case may be, as it implies, it has to do with, okay, we want to set aside a particular fund to cater for the benefits that will be accruable to our employees in the future. So it has some approaches to getting it. Like we have valuation. So those valuation would actually take care of how we get the fair value. So don't mix it up. It's not contradicting itself. Yes. So retirement benefit plan investment measure at fair value in accordance with IAS 26, accounting and reporting by retirement benefit plan. So the pension fund, as we all know. So all of this is not IAS 26 to disclosure here does not follow IFRS 13. Asset for which recoverable amount is fair value, less cost of disposal in accordance with IFRS 36, impairment of assets. So we mentioned impairment of assets earlier. Remember, when it comes to measurement, even in disclosure, you don't actually follow through on that. I hope we can see my screen. I hope I'm not just talking out of the blue.
Yes, sir. We can see your screen, sir.
Hello.
We can
Okay,
see
thank
Yes,
your
sir. We can.
screen, but it's
so
not bold enough.
Hello,
It's not
sir.
bold enough.
I can see your
We cannot
screen,
see your
sir.
screen, sir.
Yeah, I can see it too.
We can see
Your
it, but
screen
it's
is
not
clear.
bold.
We can see.
how about now?
Yes, we can see.
Can we just continue? We should just
This
make
is
Okay,
great.
okay,
This
it's
is
okay
great.
now. It's okay now. It's okay now.
No problem. So this
Your
standard came
screen is
effective
clear.
in January 1, 2013. So we should
We have
just move
always
beyond
known.
that. We are already in 2025, so we don't need to be talking about effective dates. It's already passed. So what are the terms that need to be defined? So please take note of these terms. You don't need to calm them, just understand what they mean, please. Because in the exam situation, that may cause voila if you forget the line or whatever. Just understand. I will try and explain as much as possible. The first definition here is that an active market is required when it comes to fair value measurement. So an active market is a market in which transactions for the asset or liability take place with sufficient frequency. What are they talking about
Darling,
before I
off
move on?
your mic.
When they are
Oh.
talking about
Darling, off your mic.
Répétez,
what they are
répétez,
talking about here is
répétez.
that an active market is a market in which transactions for the assets or liability take place with sufficient frequency. That is a normal routine. It's something that happens every now and then. The issue of car that I was talking about. If you really want to know the worth of that car, you take it to, let's say, a common place where car is being sold and just price it there to know what the worth will be. because people, those that will be there, the buyers there have some market information, they have some knowledge of the product you bring in, and there are some ways to measure how they price it. You can take it to 1, 2, 3 of such places, so that, so what they are talking about is that an active market is a market where that transaction is usually sold. Don't cram it. And volume to provide pricing information on an ongoing basis. They have a large amount of storage normally without you bringing your own. So that gives you a basis for you to try to understand what the price will be for that particular asset at that point in time. So entry price refers to the price paid to acquire an asset. So that means the person that wants to buy is the one that will initiate the process. That's why they call it entry price. Entry. For that's for an asset. If you also want to cancel out the liability, then you accept the payment from the person having that liability, so that that liability is being transferred away from the person to you. So when you accept payment from the person, that means the person has settled his own part, then you are owing the liability. Then when the time comes, you are the one to assume the liability and cater for it. So don't confuse it. When it comes to an asset, entry price is paid to acquire it. When it comes to liability, you receive an amount of the worth of that liability, so that you assume that liability, you become the owner of that liability. So the exit price is the opposite, just like that. Entry, exit. And exit price has to do with when you want to sell an asset, the price with which you sell it, that you let go of it. When you receive money for it, you have exited it. That means that particular asset is no longer with you. So that's not an end to it. Just like if you want to have an asset, you pay to acquire it. So you are creating, that's the beginning. So just get it as simple as that. So that means the price you will receive to sell an asset, or paid to transfer a liability. Do you remember the way I told you about liability earlier on? So let's move on. Yes, fair value is the price that will be received to sell an asset or pay to transfer a liability in an orderly transaction. Orderly transaction between market participants at the measurement date. Please, this definition, you may not need to come in, but you need to understand this. Just make sure that the message here is passed when you are talking about it. Fair value is the price that will be received to sell an asset. Remember, the entry price, or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So let's get that clearly. Highest and best use refers to the use of a non-financial asset by market participants that will maximize the value of the assets or the group of assets and liabilities, e.g., a business within which the asset will be used. Highest and best use, that means it's actually connected to non-financial assets. So what will maximize that particular asset or group of them or liability? So the income approach, so there are 3 approaches when it comes to the measurements. So we have the income, we have the market, and we have the cost approach. So the income approach is a valuation technique that converts future amounts, that is, your discounting factor. So when you use that to prepare your cash flow in terms of the income and the expenses for you to actually get what the net present value is. So when you determine the net of your asset or liability in this way, you are actually using income approach. So you get the necessary information through the active market, remember. So don't just decide that, oh, this one is this, let me put this particular one, 2 million, 2.5 million, 3 million. No, you get to the market, you get those information and use it to prepare your cash flow analysis on that basis, or discounted cash flow. So the market approach is a valuation technique that uses this price and other relevant information generated by market transaction. involving identical and comparable similar assets. The first one, don't confuse it, has to do with, yes, you get those information, but you now go ahead and prepare expectation, applying a particular rate of discounting factor to it, so that at the end of the day, you know what your net present value will be. But here, that amount that you got from the market is the basis of measuring your own directly. You don't need to start doing any calculation. So that's the difference. The cost approach is a valuation technique that reflects the amount that will be required currently to replace the service capacity of an asset. Just like, what's the replacement cost of of this asset? That is usually very keenly close to the carrying amount. Yes, because though, sorry, the carrying amount will be useful rather, but it's not closely related. But what did they use to sell into? How much did they sell this thing at this time? So we determine how much you want to allocate to it, because when you lose it, then the amount you acquire from it must be capable of replacing it. Yes, how input are the assumptions that market participants will use when pricing the asset or liability, including assumptions about risk, such as the following: A and B. The risk inherent in a particular valuation technique used to measure fair value, such as the pricing model, and the risk inherent in the inputs to the valuation technique. So it's all about the inputs, has to do with the information which you should base your calculation of what's at the what are the basis of what the asset will worth, the pricing of the asset. But in doing that, the approach you use has some risk, which has to be taken into consideration as well. So the valuation technique you use has some risk, so that's the pricing model, and the one that is connected to the inputs, the information you get, for you to do the calculation. It may be observable or unobservable. If it is observable, they are developed, they are detected, or they are identified through the market data. So, such as the publicly available information about actual events or transactions, and that reflects the assumptions that market participants will use when pricing the assets or liability. While unobservable inputs are inputs for which market data are not available, and that are developed using the best information available about the assumptions that market participants will use when pricing the asset or liability. A market participant is a buyer and seller in the principal. That is it could be a buyer today and a seller tomorrow, but he is participating in the market. That's what that means. So, our most advantageous market for the asset or liability that have all of the following characteristics. One, they are independent of each other. That is, they are not related parties. Although the price in a related party transaction may be used as an input to a fair value measurement, if the entity has evidence that the transaction was entered into at market terms. Let me give you an instance. You have a group of company. They have subsidiary A, B, C. So in between A and B, there is an exchange of assets. So the price at which they exchange it between themselves, if it follows we call it arm's length principle. That is, they only add that bargaining, the conclusion of that bargain, to assuming the market price of those transactions as at that time alone. They didn't want to see now you need to give discount now. You need to sell it at a less worth amount. No, that does not happen. If that's the case, then it's reliable. We can actually look at that as part of the sources of determining the price at which we want to fair value our assets or liability. Those that are there too, all of those that are there, they are knowledgeable. The first one has to do with the characteristics of the market participant. One, they are independent. They are not related parties. So, but if they are even related parties, the type of transaction they enter into follows the due process as laid down by the market. So, they are also knowledgeable, having a reasonable understanding about the asset or liability and the transaction using all available information. All. include information that might be obtained due to due diligence efforts that are usual and customary. C. They are able to enter into a transaction for the asset or liability. That is, they have the capability, they have the capacity, they have the money to pay when it comes to getting assets or receiving liability. They are willing to enter into a transaction for the asset or liability. They are motivated but not forced or otherwise compelled to do so. Yes. We now move to a principal market. This is a market with the greatest volume and level of activity for the asset. That's where the asset is mostly sold and bought. That's just it. So the most advantageous market maximizes the amount that will be received to sell the asset or minimizes the amount that will be paid to transfer the liability after taking into account transaction costs and transport costs. So what are the measurements when it comes to assets and liability? For assets, a fair value measurement is for a particular asset or liability. Therefore, when measuring fair value, an entity shall take into account the characteristics of the asset or liability. If the market participants will take those characteristics into account when pricing the asset or liability at the measurement date. So, such characteristics include the condition and location of the asset, restrictions, if any, on the sale or use of the assets. On the transaction itself, a fair value measurement assumes that the asset or liability is exchanged in an orderly transaction between market participants to sell the asset or transfer the liability at the measurement date under current market conditions. A fair value measurement assumes that the transaction to sell the asset or transfer the liability takes place either in the principal market for the asset or liability, or in the absence of a principal market in the most advantageous. So that's why they define the principal market and advantageous market earlier. What about the price? Fair value is the price that will be received to sell an asset or pay to transfer a liability in an orderly transaction in the principal or most advantageous market at the measurement date under current market conditions. That is an exit price. You understand now? Regardless of whether that price is directly observable or estimated using another valuation techniques. The last part here on this distinction is a market participant. An entity shall measure the fair value of an asset or a liability using the assumptions that market participants will use when pricing the assets on liability, assuming that market participants act in their economic best interest. How is it applicable? How is our best use for non-financial assets? So how does the fair value apply to non-financial assets? The fair value measure, remember that every tangible assets are non-financial. So financial assets are usually liquid. They are usually liquid, and some of the time they are not physical. For cash, you can touch cash, but most cash in these days are usually at the bank. So if a value measurement of a non-financial asset takes into account a market participant ability to generate economic benefits by using the asset in its highest and best use, or by selling it to another market participant that will use the asset in its highest and best use. The highest and best use of a non-financial asset takes into account the use of the asset that is physically possible. Remember, non-financial assets, legally permissible, and financially feasible. There are three things, and you should take note of them. The highest and best use of a non-financial asset takes into account the use of the asset that is physically possible, legally permissible, and financially feasible. So, and the breakdown of that is this: a use that is physically possible takes into account the physical characteristics of the asset that market participant will take into account when pricing the asset. That is the location or size of a property. B, a use that is legally permissible takes into account any legal restrictions on the use of the asset that market participants will take into account when pricing the asset. That is the zoning regulation applicable to a property. The third one, a use that is financially feasible takes into account whether a use of the asset that is physically possible and legally permissible generates adequate income or cash flows. Take into account the cost of converting the asset to that use to produce an investment return that market participants will require from an investment in that asset put to that use. So the same way we looked at the non-financial asset, we also look at the liability and also entities own equity instruments. They are grouped together because when it comes to accounting, they are on the credit side of our measurement. These are the assumptions that we have when it comes to liabilities or entities or equity. A liability will remain outstanding and the market participant transferee will be required to fulfill the obligation. The liability will not be settled with the counterparty or otherwise extinguished on the measurement date. B. An entity's own equity instrument will remain outstanding and the market participant transferee will take on the rights and responsibilities associated with the instrument. The instrument will not be cancelled or otherwise extinguished on the measurement date. Yes, on the liability and equity instrument held by other parties as assets. When a quoted price for the transfer of an identical or a similar liability or entity's own equity instrument is not available and the identical item is held by another party as an asset, an entity shall measure the fair value of the liability or equity instrument from the perspective of a market participant that holds the identical item as an asset at the measurement date. This is where, okay, I have a particular asset, but I got it through loan or somebody borrows me and I am owing the person I am meant to pay back. So this is now telling us that, okay, like I told you, it's a yearly exercise, an annual thing. So at the point we want to measure it, we will have to get to the market where something of such is being sold or bought. So if we are not able to see the exact liability in that manner, then we go for assets that have identical characteristics with it. An entity shall measure the fair value of the liability or equity instrument as follows: using the quoted price in an active market for the identical item held by another party as an asset, that price is available. If that price is not available, using other observable inputs such as the quoted price in a market that is not active for the identical item held by another party as an asset. C. If the observable prices in A and B are not available, using another valuation technique called such as income or market. I think we have mentioned this. So let's read the whole other parts. Liabilities and equity instruments not held by other parties as assets. When the quoted price for the transfer of an identical or a similar liability or entity's own equity instrument is not available and the identical item is not held by another party as an asset, an equity shall measure the fair value of the liability or equity instrument using a valuation technique from the perspective of market participant that holds the liability or has issued the claim on equity. So that's the way to go about that. When applying, for instance, now when applying a present value technique, an entity might take into account either of the following: the future cash flow that a market participant will expect to incur in fulfilling the obligation, including the compensation that a market participant will require for taking on the obligation, or the amount that a market participant will receive to enter into or issue an identical liability or equity instrument using the assumptions that market participants will use when pricing the identical item, e.g. having the same credit characteristics in the principal or most advantageous market for issuing a liability or an equity instrument with the same contractual terms. So when measuring the fair value of a liability, an entity shall take into account the effect of its credit risk, that is credit standing, and any other factors that might influence the likelihood that the obligation will or will not be fulfilled. When measuring the fair value of a liability on an entity's own equity instrument, an entity shall not include a separate input or an adjustment to other inputs relating to existence of a restraint or preference. So what this is talking about here is that
I can't see your screen.
others, can you see my screen?
Yeah, so we can.
Yes, sir. Can
Okay.
see it. Yes.
Okay. 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 Thank you. So what is being explained here is the fact that when it comes to liability, you don't consider what does not directly related to it. Rather, some factors that will directly affect it. And when it comes to liability, there is high level, and it has to do with when money is involved, there is usually credit risk. So when something can be measured reliably with a figure, then credit risk comes in. That is the risk that the debtors will be unable to pay back. So, but every other factors that relate indirectly to it, you don't need to put them into consideration. So when you have a situation whereby you have a liability at one hand and you have um, financial assets, and financial liability on put different on two different options. So the clear way to do is to offset it and pay or receive the balance of what the difference between the two is. So an entity that holds a group of financial assets and financial liabilities is exposed to market risk and to the credit risk of each of the counterparties. If the entity manages that group of financial assets and financial on the basis of its net exposure to either market risk or credit risk, the entity is permitted to apply an exemption to this standard for measuring fair value. That as exception permits an entity to measure the fair value of a group of financial assets and financial liabilities on the basis of the price that will be received to sell or a net long position, that is an asset, for a particular risk exposure, or pay to transfer a net short position, that is liability, for a particular risk exposure in an orderly transaction between market participants at the measurement date under current market conditions. So we need to get that rightly. There are exemptions to the rule of offsetting when it comes to financial assets and financial liabilities. So those exemption or the exemption involved has to do with the fact that what an entity is allowed, is granted the option of valuing a group of financial assets and financial on the basis of the price that will be received to sell it, not necessarily on the basis of what the market is saying at that point in time or the costs. So, and vice versa for liability, that is the price that will be required to sell or to buy liability. So an entity is permitted to use the exception only if the entity does all of the following, these three things. You cannot use that exemption until these three has been taken care of. Manage the group of financial assets and financial liability on the basis of the entity's net exposure to a particular market risk, that is, or risk, or to the credit risk of a particular counterparty in accordance with the entity's documented risk management or investment strategy. B, provides information on that basis about the group of financial assets and financial liabilities to the entity's key management personnel as defined in IAS 24 related party disclosures. C, is required of as elected to measure those financial assets and financial liabilities as fair value in the statement of financial position at the end of each reporting period. This exemption applies only to financial assets, financial liabilities, and other contracts within the scope of IFRS 9. So what is the initial recognition of fair value when you first actually discover it? When an asset is acquired or a liability is assumed in an exchange transaction for that asset or liability, transaction price is the price paid to acquire the assets or received to assume the liability. That's what transaction price is all about. When determining whether fair value at initial recognition equals the transaction price, an entity shall take into account factors specific to the transaction and to the user, to the asset or liability. For example, transaction price might not represent the fair value of an asset or a liability at initial recognition if any of the following conditions exist. You need to understand these conditions, therefore. Transaction is between related parties. Although the price in the related party transaction may be used as an input into a fair value measurement if the entity has evidence that the transaction was entered into at market terms. I think we have mentioned this before. Transaction takes place under duress or the seller is forced to accept the price in the transaction. For example, that might be the case if the seller is experiencing financial difficulty. If the unit of account represented by the transaction price is different from the unit of account for the asset or liability. For example, that might be the case if the asset or liability measured as fair value is only one of the elements in the transaction, that is in a business combination. The last one, the market in which the transaction takes place is different from the principal market. So when there is a discrepancy between what we have learned about the process of managing the situation of such, so what are the valuation techniques? We have mentioned this, so I don't want to really dwell much on that. So hierarchy, we have level 1, we have level 2 in the arrangement, level 3 as well in the arrangement of what how fair value is measured. So information we mentioned earlier that when it comes to input, there are information that are required for decision to be made in relation to or in relation to the fair value measurement. So when it comes to level 1, the peak is highest. It takes into account the quoted prices. That's it. That is a regulated price. So and this is very important that we don't have an entity does not have the right to change what the quoted price is. So level 2 are inputs other than quoted price included within level 1 that are observable for the asset or liability, either directly or indirectly. Adjustment to level 2 inputs will vary depending on factors which are the following: quoted prices for similar assets or liabilities in active markets, quoted prices for identical or similar assets or liability in markets that are not active, inputs other than quoted prices that are observable for the asset or liability, for example, interest rates and yield curves observable at commonly quoted intervals, implied volatilities, and credit spread. So level 3 does not meet the condition for 1 and 2. So as such, is connected to non-availability of information. So now we move to presentation and disclosure. An entity shall disclose information that helps users of its financial statement assess both of the following: A, for assets and liabilities that are measured as fair value on a recurring or non-recurring basis in the statement of financial position. After initial recognition, the valuation techniques and the inputs used to develop those measurements. So when it comes to presentation, disclosure is key. Disclosure is key. So these are the things that has to be disclosed. So these are the things that are meant to be disclosed when it comes to initial recognition. So subsequently, you get to the market to know what the amount is. So these are the points made when it comes to disclosure. I just want to go scan through and then take us back to where we were. So the following must be disclosed. Then a reconciliation from the opening balances to the closing balance, disclosing separately changes during the period attributable to the following: total gain or loss, total gain or loss recognized during this period, total gains or losses for the period recognized in other comprehensive income, and the line item in other comprehensive income. Purchases, sales, issues, and settlements. The amount of any transfers into or out of level 3. So, for no, the next one is the amount of the total gains or losses for the period included in profit or loss that are attributable to the change in unrealistic gains or losses relating to those assets and liabilities held out the end of the reporting period, and the line item in profit or loss in which those unrealized gains or losses are recognized. So if there is a relationship between the inputs and other unobservable inputs used in the fair value, an entity shall also provide a description. So this is all about disclosure, like I mentioned earlier. So you just need to get yourself familiar with it. So at this junction, I wouldn't know if you really want to, if you have questions to ask, you can please go ahead. Are we together?
Yes, sir. We are together.
Hello?
Hi, sir. We are together.
Yes, we are together, sir.
Okay, so any
Yes,
question?
we are together, sir.
Any question? So it seems there is none. I need to. I'm going to send this material to you guys, and let me see. Let me see if I can get hold of past questions. Okay, so there's no question, right? So we can end the class at this point. I was trying to see if I can get hold of past question, but
All right.
I wasn't able to put that out before now, so it may not be easy searching
Good
through my
evening, sir.
files.
Good evening, sir.
Good evening.
Yes,
Good
sir.
evening.
I just like to make an appeal. Is it possible for us to be getting the lesson notes before the lecture so that it can help us to speed up with you, sir?
It depends. It depends. You know, sometimes we are very busy, to be candid. For today, I had a lot of work. I just had to close my eyes on. So it depends. This is actually ready before now. Like I even have it since last night or thereabout. So sometimes if I have to work on it myself and put together, I may just be struggling with that on that day of the lecture. So I will look at that if I could get it earlier for you guys, yes, get it across. And
Okay, thanks so much,
yes.
sir. Thank you, sir.
Wow. So, in the absence of any other questions, I think for now I will call it a day. And then Mr. Taufik will see you on Thursday. So, we also have another lesson Friday that is here. So, thank you and remain blessed.
All right, sir.
Thank
Thank
you,
you, sir.
sir. Good night,
Okay,
sir.
thank you, sir. Good night, sir.
Thank you, sir. Good night.
Thank you, sir. God bless you, sir.
Thank you, sir. Good night. God bless you.
Thank you, sir. Good night. God bless you, sir.